For decades, Silicon Valley operated on a simple trade: 20% of a company for the cash to fund hypergrowth. When valuations were soaring, that slice of equity felt like a small price to pay for a massive increase in scale. This chart compares the capital-to-equity ratio between 2021 and 2026. Today, valuations have compressed. Founders now have to surrender 2 to 3 times as much ownership to raise the exact same dollar amount as they did 5 years ago. At the same time, customer acquisition costs have risen by 60%. Startups are forced to spend this expensive capital faster than ever just to maintain their growth rate. Outside of the AI infrastructure sector, traditional venture capital has shifted from a wealth creator to a high-cost dilution trap. High-valuation venture cash is currently concentrating in AI, leaving standard B2B software companies with fewer equity options. This has driven a record $68.8 billion into the ecosystem through alternative lending channels in the last year alone. Non-dilutive funding allows companies to finance growth initiatives, like hiring or marketing, without transferring ownership to outside investors. The scale of this influx indicates that debt is no longer a one-time bridge, but a strategic tool that founders are now embedding into their long-term capital planning. Equity involves permanent risk sharing and lost upside. Debt introduces a strict repayment obligation, but allows the founding team to maintain absolute control. Modern lenders are issuing billions to startups because of a shift in how they measure risk, focusing entirely on a new concept called underwritability. Lenders view monthly recurring revenue as a hard asset. High-retention subscriptions become collateral. Revenue-based financing leverages this for rapid cash. SaaS term loans provide fixed capital based on churn, while venture debt offers capital for small warrants. Because software revenue is so predictable, financial institutions can now treat subscriptions as collateral for low-cost growth capital. 10 years ago, venture debt was viewed as a desperate bridge loan, used only by startups failing to raise their next equity round. Today, healthy companies in clean tech and health tech use debt to fund acquisitions or scale operations without suffering the valuation hit of a down round. High-performing founders are now building multi-year relationships with lenders, returning for follow-on debt as their revenue grows. Securing a major debt facility is no longer a sign of distress. It is a signal that a company has the unit economics and discipline required for a bank to trust them with millions. The modern playbook uses a hybrid capital architecture, which sequences equity and debt to maximize the founder's final payout. This timeline shows the first phase, raising a small equity round strictly to discover product-market fit and build core technology. Once proven, the founder switches to non-dilutive debt to fund all subsequent marketing and scaling efforts. By the time the company reaches an exit, the difference is stark. Instead of retaining 30% after multiple equity rounds, the hybrid model founder often keeps 80% of the company. Retaining 80% of a company instead of 30% means the founding team captures more than double the proceeds of a sale or IPO. Founders are now optimizing their capital structure as a strategic choice to ensure they maintain ownership of the value they create.